Walk down any city street and you'll see it. For sale signs. For generations, this was the symbol of the American dream. A place to raise a family, build equity, and put down roots. But if we look closer, something has shifted. That sign doesn't just represent a home anymore. It represents a financial instrument, a hedge against inflation, an asset in a global portfolio. Today, let's look at the real estate machine. To understand the housing crisis, we need to recognize a fundamental change in how we treat the places where we live. For most of history, housing was viewed as a utility, a basic human need like water or heat. But over the last few decades, we've shifted toward financialized housing. In this model, the goal of a property isn't to provide shelter, it's to maximize return on investment. When a house becomes a financial product, it stops competing with other houses based on how livable it is. It starts competing based on how much profit it can generate for a distant investor. After the 2008 financial crash, the real estate market was flooded with foreclosures. While families were being kicked out of their homes, massive hedge funds and private equity firms, companies like Blackstone and Invitation Homes, saw a bargain. They bought up tens of thousands of single-family homes in cash, sight unseen. They turned thousands of neighborhoods into massive rental complexes managed from headquarters hundreds of miles away. This changed the power dynamic forever. If your landlord is a local person, you might negotiate a rent increase. If your landlord is a multinational algorithm based in New York, you're not a tenant, you're a revenue stream. When these companies own a significant percentage of a local market, they have the power to artificially inflate rents because there's nowhere else to go. We often hear that the housing crisis is just a supply and demand issue. Just build more. And while supply is part of the equation, it ignores the type of supply being built. Developers aren't building starter homes for families because they aren't as profitable as luxury condos or market-rate apartments for high-income earners. The housing machine is programmed to build where the money is, not where the need is. We're trapped in a cycle. We build expensive luxury units, which drives up the property values of the surrounding neighborhood, which makes it even harder to build affordable housing, which leaves the working class priced out of their own cities. What happens to a society when the majority of its population spends over 50% of their income on rent? Human health suffers. Stress levels spike. We see the erosion of community because when people can't afford to stay in their neighborhoods, they move. They move further away from their jobs, their families, and their support networks. This isn't just an economic problem. It's a social, physical, and psychological crisis. A society that views shelter as a speculative investment is a society that has decided that the comfort of investors is more important than the stability of its people. So how do we stop the machine? It's going to require a radical shift. It means treating housing as a human right, not a commodity. It means implementing rent controls, taxing corporate ownership of residential properties, and, most importantly, supporting non-market housing like community land trusts and public, nonprofit housing developments. We have to choose. Do we want neighborhoods or do we want portfolios? Because right now, our system is forcing us to pick one or the other.